Thanks for tuning in to Talking Point. I'm your host, Neeraj Shah. Our guest today is Vinay Jaising, MD of Portfolio Management Services at JM Financial Services. Vinay, great having you. Thanks so much for taking the time out and speaking to us again.
Pleasure's all mine.
Thank you. So, Vinay, put risk assets into perspective from how do you look at them? Because, when just looking at the Indian markets vis-a-vis global competing markets, how do you assess the strength versus the vulnerabilities?
So it's interesting. If you had spoken about 3 months ago, India was down on a one-year basis, CYTD basis by about 6-7%. And low, in the last 3 months, India has grown 10%, the world has grown 11%, Nasdaq's grown even higher. If you look at YTD numbers, Nasdaq's up 30%, Japan is up 20%. India's getting there, but it's more in the 3, 4, 5% cadre. So India has had a amount of underperformance which has come up this year. Having said that, as far as economics is concerned, the GDP growth in India, which came out of the last quarter, 6.1%, fantastic. The tax collection number for GST, 11-12%, again, great. Inflation numbers are tapered down. Yes, one could say that the tax collections for direct taxation with the corporates have paid have not been as good at 10-11% as compared to what it could have been. But the direction is on the right way. The IIP numbers are inching up. So I think if you look at India's any number, PMI numbers, both manufacturing and composite at about 58 and 61, 62, it seems to be telling us India should be decoupled and moving in the positive direction on the economy front and hence on the equity front as well relative to its peers. Having said that, clearly, if you look at one very important macro parameter, which is the 2-year and 10-year chart of US, you're at negative 90 to 95 basis points. The 2-year chart is at about 4.7. The 10-year chart is at about 3.72. The differential is negative 90 to 95 basis points. And that tells you that there could be a lot of pain coming up in the US in the short term. And that would be the risk for the world as a whole. India should get a little more scot-free than the rest of the world because of its economic parameters. But clearly, we can't factor in something much, much better than the rest of the world.
Got it. Okay. So, you referred to some of the macro indicators. I kind of tend to combine them with the high frequency indicators around trading as well. What VIX doing, what it is doing, just the kind of FI buying that we've seen in the month of May and June. 60,000 crores is not a joke at all. So how do both of these combine for what equity markets could do, in addition to, of course, what we normally talk about, which is the kind of valuations and the kind of earnings growth? And we'll come to that as well.
Sure. So first, let's talk about, one thing which has been going anti the Indian market in the last 15 months. I would say 15 to 18 months, and that is the currency. Currency in January of last year was at about 74. Today, it's at about 82. So if you see the DXY, it peaked at about 115. Today, it's 102. But the Indian currency today, this year, has been flat at 82 and change, 81.9, pretty much in that narrow band. So if you were an FII and if you were looking at last year, on an absolute basis, markets up 20%, but your currency is taken away 10% of the gain. So there was a pain point coming in that the currency is hurting your gains if you were an FII. So last year, what did FIIs do? They took out about $18 billion of cash from the country. This year, you started with Jan, Feb, March, wherein they again took out $2.5 billion of cash from the country. Then comes, as you rightly put it, April, May, June. The fiscal 24 looked fantastic. And overall, this year, the calendar year, you're at about $5.5 billion, or from April, May, June, as much as $8 billion. The reason they're doing it is the FII ownership in the India is probably at a 5-6 year low of about 19%. Down from 21% because of the outflows last year and because of the rupee devaluation in the last year. So these are the two pain points which the FIIs had in the past. Having said that, with crude and coal being where they are at about $75 and about $155 a ton, I think it's time to smile for the rupee, and the rupee should appreciate or at least stabilize at current levels in the next 6 months, which is why FIIs should be looking at India a lot more than they did earlier. Also, the China trade, you're seeing hiccups. You saw 1 quarter of good growth. You saw the M2 in China go up by as much as $6 trillion. People got excited there. The markets went up. And then again, the markets corrected, and now on a one basis, the markets are down by 3-4%. So what do the FIIs have to look out of US and probably Europe is a good growing market, and that's where I think India comes in. As far as valuations are concerned, if I were to look at 1 year forward EPS, we're probably trading at 20 times, in line with last 5-year average numbers. So that's pretty good. So earnings growth should be giving you a index growth incrementally, which means if the index is today at, let's say, 19,000 levels, a 15% upside in line with the earnings growth would keep the P at 20 times. I think that should be a fair base case assumption. Having said that, as you rightly said, we are at peak, right? Remember, there could be volatility. The VXY is at about 10. So you could see tepid, 18 to 19,500 levels, at least for a month or two, before you start seeing the next quarter's earnings, which should see very good earnings growth as far as margins are concerned.
Okay, actually, that was going to be my other question, and which is earnings growth. If earnings growth is, I was reading a note which said that it's the first time that we've seen a hat trick of double-digit growth. FY 21, 22, 23. It didn't happen even in 2003 to 2008. But the start of this current fiscal, Vinay, and the latest numbers that have come out on the tax collections, corporate India tax collections, YOY, have actually come off. I have this net CIT number, right? It is down 8% compared to Q1 FY23. What gives?
So, if we break down the earnings of FY21 and 22 and even FY23, the incremental growth of India Inc. came from the financial sector. The financial sector last year, as far as index was concerned, gave as much as 45% of the earnings. In FY23, we barely made it to double digits. So I was smiling when you said double digit. We were literally at 10%. And of that 10%, if you take out just one sector, which is financial sector, we were down by 3 to 4%. Having said that, in the last sequential quarter, you've seen an EBITDA margin improvement of about 150 basis points for the non-finance stocks, courtesy the commodities coming down. And you've seen the volume growth of about 3-4% and a value growth of 10% because they haven't cut the prices of biscuits. You're selling, you're buying it at the same price. So you saw a good non-financial growth, but on a QOQ basis of about 30% as far as profits are concerned. Despite that, we were down for the year as a whole. So you can imagine the next year, which is the year FY24, how it would be driven. You won't have COVID gains which the finance companies had. So that 40-45% growth which the finance companies were giving would go down to about 15 to 20% in line with the loan book growth. But the other sectors would start contributing. And that's the reason why in the first quarter, the finance sector not contributing as much, the metal sector not contributing as much, even the auto sector, which grew at about 110% last year, not contributing as much, would lead you to believe a 10-11% growth is what they've done in the quarter. But I think what you'll see in the remaining part of the year, a 14 to 15% growth for India Inc., but driven by the non-finance companies for fiscal 24. Different from the trend in the last 3 years.
And therefore, it's wrong to qualify it as a slowdown, I would reckon. We're not looking at a slowdown. If anything, it's a broad-based uptick, save for financials.
Absolutely. I would say even the India Inc.'s earnings, if you want to be super bullish, if it grows at 15, last year grew at 10. So you're seeing a 50% growth incrementally in the earnings from last year to this year.
Got it. Okay. Now, I would love to understand, we did an exercise last week. About 55 odd companies showed EBITDA margin expansion in each of the last 4 quarters, Q1 to Q2, Q2 to Q3, and Q3 to Q4. So there were 55 such companies, and there were about 170 odd companies on the NSE 500 which showed EBITDA margins much higher in quarter 4 than what they were in quarter 1. So we've seen that strength on the operational front coming in. You spoke about volume growth in select pockets, building materials, so on and so forth. So there are these pockets of very strong inherent strength that we are starting to see. As somebody who is managing this whole portfolio management business at your end, Vinay, what is it that you are excited about? And where is it that you believe, things are priced in?
So, it's interesting. The margin growth in the last quarter came exactly similar to the previous quarter, which was because commodities fell down and the pricing power was there with the end supplier. Now, this commodity pricing is not slowing down. India is now contributing about 40%, give or take, change of Russian crude, as a result of which our incremental price of crude is at about $70 or sub, considering the freight it takes to reach from Russia to here. So your input bill itself, which was 208 to $10 billion last year, could go down to as much as 150 to 160 billion dollars.
Wow.
Same story with coal. So what, and if you go to other commodities also, you've seen a 35% from their peak reduction. So you are seeing margins do well, and you're seeing margins do well in those sectors which are driven by Capex, which includes cement, building construction, discretionary spend, and more so, power build industries, wherever you're seeing a make in India story come up, like defense, like railways growing in terms of Capex. And I think that's the trend where we would be focusing on, where historically you would never have a definition of order book to revenue growth ever thought of. Now the order book to revenue growth in a couple of sectors is as much as 6 to 8 times. If it's as much as 6 to 8 times and you believe cash is king, these sectors is where we would be focusing on, a little lesser than what we would focus on the financial sector as compared to what we did historically. Moving to your second question, what would we avoid? So when we are facing domestic facing sectors where we are putting in our money and we are a little conservative, the rupee, I think the global facing sectors, which is IT, a couple of pharmaceutical companies or that space is where we will be lesser. But the definition of lesser is we would at least have 20% of our weightage globally as well. Because remember, 4 to 5% has been the rupee depreciation for the last 25 years. So you don't want to be caught napping. So over the longer term, you need at least 20% exposure to globally run companies. Just one more comment out here. When I say Capex, you've got a lot of make in India stories which are replacing Capex as well. I mentioned defense out there. Just assume, if we were buying a lot of our products in defense from the rest of the world, and now you've got companies in India which are producing it, and courtesy the Indian government, a lot of orders are going to them. That's where the order books are swelling. They don't have a balance sheet issue. They're net cash, most of them, which means whatever is the top line growth, as soon as the execution occurs, the EBITDA net profit growth could be as much as 15 to 25%, depending on the defense company we're talking about. And it's the same story for most of the Capex companies.
Yeah, it's interesting. I was looking at the bets that you guys are taking on the Capex side. So there's this whole building material pocket that you're betting on, and you're on the capital goods side. Interestingly, I saw that the normal names which dot a bunch of funds, etc., just are not there. You playing fairly themes with a specific vertical expertise, be it water, be it something else. Now tell us a bit about it.
Sure. So, ESG is the theme which has been world over acknowledged for the last 3-4 years. So you mentioned water. It ticks the box everywhere. Earlier, why we didn't look at the water theme was it was the municipal corporations which were giving orders. Now it's going more at the central government level, which means that the working capital, which was the only problem companies, which were into water treatment were having, is solved. As a result of which, the balance sheet is improved. So you're not just getting revenues, but you're actually getting real cash flows. And these stocks are at 10, 12 times 1 year forward P. We just mentioned earlier, valuations at 20 times for India, if they sustain. But if you can get stocks which are at 10 to 12 times P with an earnings trajectory of 20 to 25%, it kind of becomes a win-win situation. So, one is what? The second is there are so many normative changes which the government is doing for improving the quality of air that, you're moving in from one specification to the other specification and a couple of engines, DG sets. You again have a couple of companies there which are 10 to 15 times P. So we are looking at A, growth, but B, reasonable valuations, which is always been a core of our concept of investing, and C, return on capital employed. If all these are ticking box, those are the Capex companies we're gaining. Earlier, we had companies which are at 50 times PE multiples, which have but moved to 80 times. So incrementally, to justify them in our portfolio is becoming a lot more difficult.
Okay. Yeah, well, can imagine. The thing that intrigued me was your underweight stance on metals, considering that after a lull over the last 3, 6, 9 months, there is a strong talk of how the balance sheets are not that leveraged. They are doing their own capex in a good pace, and earnings growth might be visible in FY24 or FY23, presumably because of this whole commodity price deflation and the input price deflation factor. Why don't you like metals?
We're not being able to take a stand as a company of how China would do. If you look at the inventory levels which are being built in China, in couple of the metal space, steel is a little better than aluminum. This inventory level is very difficult for anyone to decipher. It depends on how the rate of growth of China is going to happen.
True.
So why take the risk? I think, frankly, that's the only reason. If China starts singing and we see a growth not of 5.1%, but of 7%, we'll be into metals again.
Okay, I get the drift. The other, another question is, and there are portfolio managers of type A, portfolio managers of type B. I'm just trying to bring together. There are some portfolio managers who, in what is looking like a bullish or an up cycle, tend to bet or tend to have 5-10% of their portfolio on bets which could be dark horses, which could really gallop on earnings front or valuation front, or a combination of both. Are you taking such bets, or is the portfolio largely or 100% around steady state 15-20% earnings growth bets?
So our average portfolio earnings are 5% more than the index. Our average ROC is about 5% more than the index. So, for earnings and quality is very important.
Okay.
But yes, we take 5 to 10% of our bets in those stocks which are a little riskier with our 10 to 12 times P, so that we can get a multiple for our index, our overall portfolio a little lower. So we believe very genuinely on growth at reasonable valuation, but ROS is very important. And 5% higher ROS is what our index, our portfolio is giving. That's where we would want to look at our alpha also in the future.
Got it. One quick Capex related question again, because that's such a big theme that everybody's talking about, Vinay. Railways, if defense was the talking point of 2022, it seems to be railways 2023. Has it impressed you, or would you rather see some more proof of the pudding?
No, it has impressed us substantially. It is very difficult to believe what the railway companies are doing today as compared to what they were doing historically. So the same theme which we mentioned to you in Capex, the order book to what they are executing is great. So there are companies which have an order book of 25 plus thousand crores with revenues of 3,000 crores. It will take them a year or two to chug on and start building the order book and executing it. But thereafter, you'll start seeing them grow on the revenue base fantastically. The good news for them is, again, their cash position or their balance sheet are very good. So selective picking for us in railway sector has already started.
Interesting. Yeah. And the reason why this comes in, it's because that's a sector more than any other that has had such a heavy baggage of the past, that for disbelievers to start believers, it takes a really long time, and rightly so, because this sector is, flattered to deceive so many times in the past. And
smack on. So again, use the same two principles we said. Do you get a company less than the index, which is 20 times 1 year forward? If the answer is yes. B, forget even if it's grown by about 50% in the market in the last 12 months. Is the order book very strong compared to its revenues? If it is 3 to 4 times, maybe it's 7 to 8 times on companies we are talking about. It's a matter of this year or next. The company's earnings will not grow at 10, 15, it will grow at 25, 30. Those are the companies to bet on. But again, very, very important to focus on their balance sheet, because working capital cycle can be disastrous for some of these companies, and they can be in cash flow. That's where we are very careful of.
Very well put. Thank you. Vinay, last two questions before I come to the risks to this whole very good sounding story. A word on real estate. And the reason I bring it up is because the last 2 years, I've heard enough and more people talk about how an upcycle in real estate lasts a number of years, and an upcycle in real estate is very crucial for jobs, for the kind of generation that happens on the economy, so on and so forth. Now, my question to you is, there's a bit of a change in the way, one, that these guys are recognizing revenues and declaring their numbers. And they're also declaring pre-sales numbers along with it. And for a lot of companies, the plans that they've put out over the course of the next 5 years make it feel that every company is worth buying. So I'm trying to understand, How do you look at this pocket? And if you are buying into them, or if you are having them in your portfolio, how are you choosing these companies?
Sure. So, the first company, why people are excited about real estate companies, in the last 5 years, prices of real estate has not gone up as much as one would have expected. One can say it's even flat. But, your salary has gone up by an average CAGR of 10 to 11%. So affordability for you is a lot more easier. Second, interestingly, India's interest, which has gone up post-COVID, has been only 2.5%. But remember, there was a time wherein India's interest rates were 15 to 20%. So what a customer is paying as far as interests are concerned for their mortgage is not very big number compared to what they did earlier. So again, affordability is fantastic. Third, there was a lot of supply which was coming up earlier. Quality of supply was also a question mark. Now that incremental supply in the last 2 to 3 years has not come up as much, and new projects are not being announced as much as was earlier, you're actually completing the older projects. So you're seeing inventory being replaced and coming down. So I think these are the three reasons why people are really interested in the real estate industry. Having said that, courtesy the disclosure levels, the stocks also have run up substantially. So the way we are currently playing the real estate industry is the second derivative, which is the building automation or the building construction industry, be it cement, be it tiles. There are many other ways to play it, and those are the way, the electrical companies, those are the ways we are playing this cycle.
Got it. Okay. Final question. What are the risks, Vinay, to this very hunky-dory sounding India story? We are at the week wherein PM Modi will visit US and then visit Egypt to do an INR-led deal, which a lot of people talk about, that if India manages to do a lot of, will make it a structural story and no longer a cyclical one, so on and so forth. But what are the risks that you foresee to this India story?
So I think there are three risks. The first risk is the crude risk, which is a lot more lesser today than earlier, courtesy our tie-up with Russia, but crude risk can never be forgotten by anyone. The second risk is very simply the geopolitical risk, and that's the entire world risk. People are not talking much about Russia and Ukraine, but that's not over. The third risk is really the political arena in the next 12 months, what happens there. We won't talk much on it because we are not experts in that subject, but stability is very, very crucial for us. So these are the three risks. Apart from that, I think the level playing field is being made for India in manufacturing. As far as taxation is concerned, GST has got unorganized to organized. Finally, the rupee looks a lot more stable. So these are singing your way. So there's one global risk and two India-specific risks or concerns, which time will tell us.
Yeah, let's hope. The rupee turns out heads and not tails. I mean, with the presumption that heads is the winning call. But Vinay, thank you so much for taking the time out and speaking to us today. Lovely talking to you as always, and look forward to have you more often on the platform.
Appreciate your time. Cheers.
Thank you. And viewers, thanks for tuning into this edition of The Talking Point.